Think for a moment about the money in your wallet or the numbers on your bank screen. You earned it, you worked for it, and you assume it represents a fixed, tangible value. But what if the very concept of money, the financial engine that powers every transaction, every market, and every empire, is nothing more than a glorified eye? Oh, you? What if the vast majority of the money supply circulating in the global economy is fundamentally debt? This isn't a conspiracy theory. It is the deliberate, necessary function of the modern financial system, and it is the mechanism that locks us all into the perilous global debt cycle. To understand why the entire world is drowning in sovereign debt, you must first understand the hidden truth behind fractional reserve banking, a historical accident that became the single most powerful engine of wealth and of collapse ever devised. Our story doesn't begin in the sterile halls of a modern central bank. It begins in the workshop of a 17th-century goldsmith in London. People trusted the goldsmith. They didn't trust keeping their precious metal under their beds, so they deposited their gold with him for safekeeping, receiving a paper receipt, a promise to return the gold upon demand. These receipts were the earliest form of banknotes. Over time, people began trading the receipts directly, instead of constantly hauling the heavy gold. Those paper notes became the money. Now the goldsmith, noticing that only a small fraction of his depositors ever came back to claim their gold, at the same time realized a crucial, revolutionary fact. He could lend out the majority of the gold he held, only keeping a fraction of the total deposits in reserve. When he issued a loan, he didn't hand over gold. He simply wrote a new paper receipt, a new promise, creating what felt like new money, literally out of thin air, for which he charged interest. This was the birth of fractional reserve banking, a system built entirely on confidence and debt. This seemingly simple historical anecdote is the DNA of every commercial bank today. When you take out a $300,000 mortgage, the bank does not transfer $300,000 from someone else's savings account to yours. The system is elegant, but terrifyingly unstable. Because the entire money supply is built upon a small fraction of real reserves, the foundation of the system is psychological. The moment depositors lose faith, a loss of confidence triggered by a war, a failed bank, or a debt crisis, they rush to withdraw their funds. This is a bank run. The bank, having only a fraction of the money on hand, instantly collapses, and the entire credit creation mechanism grinds to a halt. This fragility is precisely why we needed a lender of last resort, the central bank, such as the Federal Reserve. The establishment of the central bank was the formal admission that the fractional reserve system is inherently unstable and requires an external, unlimited source of stability, a body empowered to print the reserves needed to backstop the entire chain of debt. This brings us to the modern paradox. The central bank has now become the ultimate manager of the debt cycle. When the commercial banking system freezes up, as it did in 2008, the central bank intervenes with programs like quantitative easing, QE. Key is the process where the central bank purchases massive amounts of debt, like government bonds or mortgage-backed securities, from commercial banks. The central bank creates new digital reserves to pay for these assets, pumping liquidity into the system and preventing the debt mechanism from seizing up. The irony is that the tool used to stabilize the debt-based system is itself a debt creation mechanism. It essentially monetizes government debt, allowing the endless cycle of borrowing to continue, only now at a far grander sovereign level. The core truth remains: your purchasing power, the stability of your economy, and the future of global finance are all dependent on a system where money is created only when someone agrees to take on debt. This means the economy must perpetually expand its debt burden just to keep the existing money supply from contracting. If the world stops taking on debt, the money supply shrinks, and the economy collapses into a debt deflationary spiral. This forces central banks and governments into a continuous, desperate push to keep the credit flowing, pushing the entire global economy further into the very same debt spiral we decoded in our last video. The challenge for you, the informed viewer, is to recognize that you are operating within a system where your savings are technically a bank's liability and your money is tied to its interest-earning potential. Understanding this foundational reliance on debt is the first, crucial step toward protecting your wealth against the coming financial resets. If this analysis of banking history and macro mechanics gives you a clearer view of the road ahead, please consider subscribing. By joining our community, you support the independent analysis needed to cut through the complexity of the mainstream financial narrative and decode the next crisis. Next time, we're going to take this deep dive into instability and apply it to the credit markets. We will explore one of the most predictive frameworks for financial bubbles, the Minsky moment, the only indicator that guarantees a credit collapse. We'll show you how debt moves from stable hedges to speculative manias, and why the final collapse is an economic inevitability. Don't miss it.